Good afternoon, good evening, whenever you're listening to this, good morning. This is a TRG podcast with Doug Harbaugh, Chartered Retirement Planning Counselor, and I got one of my junior advisors and investment strategists here, Luke Lloyd. How you doing, man?
I'm doing well. It's a good day.
Doing well. Is it?
Market's not actually up today.
No, it's not actually up today.
Which is surprising.
It's surprising. Why is that?
Because it feels like every day we're up now.
Are we?
It feels like that.
Okay.
We're still down 13% from the highs, as we were just talking about.
So you took my show notes.
I did just take
He took my show notes.
Yes.
Okay. So today we're going to talk about a little bit, obviously, about the disconnect that I feel exists between the market where it's at today and what's actually happening economically. So we'll try to have a little fun here. Luke is a tech nerd, meaning
I'm just a nerd, not just tech nerd.
I'm
just a nerd.
We'll go with nerd. But at the end of the day, and we're not talking about, video games or, PC systems. We're talking about technical analysis. And there's two different schools of thought when it comes to investing. And the reason why I wanted to talk about this today is I don't feel a lot of advisors do either, okay? And what I mean by that is, let's say you go to a certain shop and you go in there and you meet with your advisor and he's in this strip mall or wherever he's at, and you go in and he sells you some mutual funds. And what I've come to the conclusion is over the course of a year, there's no change,
right?
Meaning that they're going to buy some mutual funds and let you sit in it. So today, I just wanted to touch on some things to let you know there are better options available to you. And one of the ways you get to it is technical analysis. But before we get to technical analysis, we should touch on fundamental analysis. So there's a bit of a difference between the two. So fundamental analysis looks at the intrinsic value of investments. People are like, whoa, wait a minute, time out. What are you talking about? So intrinsic value is the value of something, right? And when it comes to the stocks that we purchase, the companies that we're investing in, they have a value. And that value is based on what they're making, are they a leader in what they're making, and do they have predictable revenue? So fundamental analysis is long-term investing. So that's something where we're looking long view and we're going, how predictable can we make this product, right?
Well, there's all kinds of ratios that go into fundamental analysis, like price to earnings ratios, debt ratios. There's all kinds of stuff you have to look at.
Book value
per share, things like that. So you can actually see
assets minus liabilities divided by outstanding shares.
Thousands of variables you can look at.
You can figure out all these different ratios to figure out how a company or a stock is valued, right? So when people use fundamental analysis, we're using a form of accounting, right? To figure out the value of a stock. That's number one. And a lot of people like that school of thought because we have predictable values based on what's happening economically and based on the consumer. Now, when it comes to technical analysis, this is where the nerd here gets super excited. Lloyd, is that what's your heritage? What is Lloyd?
It's Welsh.
Welsh
and
Polish.
For as much as and Hungarian.
And Hungarian. For as much as you love what we're going to talk about, and it's technical analysis, but the one thing that he loves is something called Fibonacci.
Right.
You would swear the kid was from Sicily. Okay.
Right.
Maybe you converted to Sicilian.
Maybe my family did. I have to ask my grandparents. Maybe.
Are you sure we're not Italian or Sicilian?
Right.
For
the dark features.
For as much as I like Fibonacci, so when it comes to technical analysis, the difference is it's more of a short-term view. And you have, again, fundamental traders and technical traders. And occasionally you have people that merge a little bit like us, right? We like to look at both views to understand what's happening in the market. So give me a little basis on technical analysis.
So like you said, fundamentals the way you can kind of perceive it as accounting, right? So it's a form of mathematics that way.
Okay.
But technicals is a different kind of mathematics where it's all based on supply and demand and price action from the underlying security.
What do you mean price action?
You're looking at graphs. You're looking at what the graphs are doing.
But explain to people what price action means.
So price action, I guess, what I mean by that is the stocks, being bought and sold every single day, right? So you can kind of track who's buying it, what price they're buying it, or who's selling it, what price they're selling it at. So you take all these different metrics like that, and you kind of plug it into kind of different formulas, and we're going to talk about those different formulas, like the moving averages or Fibonacci. We're talking about all these different mathematics behind it, and you're plugging it in there to see where support and resistance levels are. Okay. So it's kind of like
slow down. See the kid, he gets excited.
I do get excited.
I want to slow him down. So what is a support level?
So support level is where buyers typically come in. So it's where a stock should bounce at.
When you say bounce, like we're bouncing a ball off the what?
So let's say
off of the what?
Off of the support level.
And the support level for bouncing a ball.
Yep, is going to be
the floor.
The floor, of something. Yeah, the potential floor, I guess you should say, because
correct. But that's we're talking to the general audience, and we need to make sure they understand. So people are buying it at a support level. So when you see the support levels, it means the value of something went, bounced, bounced, and usually after 3 bounces.
Yeah, triple bottom. If it doesn't hold after that, it tends to fall through.
So what we're saying is once you get a few bounces, 3 to be specific when it comes to technical analysis, you start to get a trend line.
Yep.
Right? Because then we could say this is our new support level because it's hit this and people have bought in to bring it off of that level. And resistance, or the current
top or ceiling.
Okay, so
I see where you're going with this.
Okay, to say he's slow and fast at the same time.
Exactly, it's weird.
Okay, so we have this new ceiling, and that new ceiling or resistance. Because if I jumped into the ceiling with a hard ceiling,
that would
what
hurt
happens?
Pretty bad. Your bald head would hurt pretty bad.
Right, I'm going to bump my head on the ceiling coming out. So when we're talking about these values of these stocks, we have a floor, and we're looking for a trend off that floor. We're bouncing that ball. And we have a ceiling. If I'm at a trampoline in a house, well, if I jump too high, I'm going to hit the ceiling and bump my head. Right? And if I bump my head 3 times, what do we have?
You have a trend.
Well, we've had resistance 3 times because I've just hit my head 3 times on this.
But you have a trend line on the top, right? So you can kind of say, hey, this is the level I'm going to look at to sell my stock.
And is that a trading range?
It's a trading range. It is. So there's all kinds of things. So like you said, trend lines, trading ranges. Okay. I mean, there's all kinds of terms you can use to see this stuff. But really what's important about technicals is it allows you to base your buy and sell decisions on where these levels are. And that's something fundamental analysis typically doesn't give you, because fundamentals will say, okay, this might be a long-term investment because it's undervalued, or it's not a good long-term investment because it's overvalued, right? But it doesn't give you the exact price points you should buy and sell at.
Right. So the current 200-day resistance is at 2990 for the S&P 500, okay? And we're trading at 2950 today.
Right.
So that means we are 40 points away from
over
what?
1%. From a resistance point. It should act as a resistance point.
Okay. So what happens if we go over that resistance point?
Well, what we want to see is a true hard close above that, because here's the thing. Technicals say, okay, this is where you should buy, this is where you should sell at, but it's not like a hard set point, right? It's you have to give a little bit, right? You have to give plus or minus 1%. So if we see a hard breakthrough above that range, we could easily see a break up to 3,200 or even the all-time highs.
Okay, so I got a brain cramp, and I'll have to look up her name. But Kramer was just talking about it the other day when it comes to the specific. She's a Fibonacci fan, and what is her name? I'm having a hard time remembering here. That's why I look up Carolyn Barodin. Okay. Right. Big Fibonacci fan. She believes that if we cross this, right? Are we going to be talking about the golden cross at this point?
This could be the golden cross. So if we hit the 50-day moving average, cross above the 200-day moving average.
Okay. So if our 50-day goes above that, she's predicting an additional 27%.
Could happen because it tends to be a very strong point to where the short-term trend line is better than the long-term trend line. Okay. So you see a lot of momentum behind the stock.
Okay. So it's momentum, and why is there momentum?
Because right now the Fed Reserve kind of is back in everything. So it comes back down to the fundamentals kind of right now that are happening in the economy are supporting all this. But these price points, if it gets above these levels, that means there's not many people there to sell it at. So it moves quickly through these levels.
Okay.
So it can easily retest
So it moves quickly, but help me understand something. So we've got a fundamental problem, right? GDP shrink by nearly 5%, and they're talking a 40% contraction, right, for Q2. And then we've got technicals that are potentially on the completely other end of the spectrum.
Right.
And they're moving, number one, maybe because of consumer retail confidence and people buying in. But also it's primarily because the government's printing money.
They are.
So when I see that kind of disconnect, meaning that fundamentally these companies aren't doing as well, we have massive job loss, right? So right now, it's almost like it's just like a computer's, it's like a video game. Like it doesn't make any sense why we're trading the way we are. And again, the reason why I want to touch on these things is if you're working with an advisor and that advisor bought those mutual funds and you haven't changed anything in a year, 2 years, you have to ask yourself, what is that guy actually doing for you, right? And that's why we have these podcasts to kind of help enlighten you as to some of the things that you can be looking at. One of the things you can look at, if you would like, is you go to trg.swpconnect.com and go to Portfolio X-Ray. From there, you're going to enter in your top 10 holdings. What my staff is going to do is they're going to put together a detailed report for you to let you know where you really stand on an investment level. They're going to let you know if you have too much risk in the wrong sector, maybe not enough risk, or the wrong risk. But go to trg.swpconnect.com to check that out. That's trg.swpconnect.com. So back to what we're talking about here and why we're touching on these things. And why I want you to really look at what you're currently doing, and why I want you to go to our page to do a portfolio analysis by doing Portfolio X-Ray, it's because we have a huge disconnect between fundamentals and technicals, right? So it's possible, it's very possible that we break through this new resistance and we jettison through the roof while we simultaneously have terrible economic news. And if that's the case, the only way we continue up is if the government prints more money.
I think the market right now also, real quick, just going on the fundamental side. I know we're talking focus on technicals, but we saw numbers today from the unemployment, right? They also were worse than expected, like they have been the past 3 or 4 weeks.
What was the number, 2.5 million?
2.5 million expected was like 2.4. So we still are above the expectations.
Yeah.
It's worse than they're actually saying. But the government, like you said, is printing a ton of money. So with that, the government doing that I think the market right now is pricing in that, people are actually making more money than they were when they were actually employed. So they're still going to be stimulating the economy with that. So that's one thing I think the market is driving the market up. And you're basing a lot of the decisions, traders are basing the decision on technicals as well. And when we sold off the 2200, 2300, there's a technical indicator called RSI, Relative Strength Index.
Okay.
And when the RSI gets below 30, it tends to mean that we're oversold. Okay. If it gets above 70, we're overbought.
Okay.
The RSI on the S&P was sitting around 25, which means extremely oversold conditions and something that we rarely see on the S&P 500. So that's why you saw a very hard bounce from 2200 back up to the 2500, 2600 area.
Okay.
And then we started breaking through Fibonacci resistance levels.
Fibonacci.
Where we talk about the 50% and we talk about
Why don't you rattle off the Fibonacci number?
61.8% golden ratio.
No, keep rattling. There's like a whole nother
there's like
number. It's almost like pi.
Well, it's kind of like pi. Well, pi, 3.141592653895, but we won't go there.
Nerd.
Yeah, I know. That's all I memorized. But the golden ratio, the main Fibonacci level you're looking at, 61.8, and the Fibonacci for the S&P is sitting at 293. And I believe the 50% retracement, which is also a very important Fibonacci level, I think was sitting around 273.
Tell people what retracement is.
So when you take a top and bottom and you just draw the ratios between the top and bottom, then you get the retracement level. So you get a 50% retracement would mean between this top level and between this bottom level, that 50% between that is your 50% retracement. The 61.8% would mean that 61.8% retracement would be 61.8% from the top. Right. In opposite, 38.2. And
they don't know that. Slow down.
Sorry. So 38.2%, I guess, retracement from the top is where we're sitting at basically now. Right. We busted through the 293, and it's kind of going to act as a support level going forward. We're sitting around 29.50 right now. 29.30 should be a good level that you should look into buying if you're going long. But at the same time, there's a lot of craziness going on too that the market could discount fundamentals, whatever it be. So if you're basing just on technicals, there's a lot of important levels we're sitting at, and there's a lot of reasoning behind where the market kind of bounced and where's that now. But we could see, like I said, we need to see a break above the 29.90 to really see important breakout above.
Right, and look, obviously we all want the world to get better, and do we feel like this economic shutdown was a bit overreaching? Yes. Did they really have a playbook and know what they're doing? No. So it's like it's hard to say shame on you for making me stay home. It's also hard not to say shame on you for making me stay home. And what it's done to the economy, because again, we have a couple of things that are happening, and they're trying to pass more stimulus. And hey, great, we'll go back to the happy days are here again if they keep printing money. But unfortunately, for every pro, there's a con typically, and you can't just keep making money print and expect people to stay home, make more money at home than what they were making and expect them to ever want to go back to work.
Exactly.
Right? And if they don't go back to work, we're going to create sector job loss, right? And when we have sector job loss, we're going to hurt entire industries, right? Let's say maybe it's the auto industry, whatever it is, right? And people are just like, I'm not coming back to work. And then their excuse is, well, I'm afraid of coronavirus. And I'm not coming back because of that. And you can't make me come back. Yeah. And I'm going to sit at home and collect this additional PUA money, right? And I'm going to collect my unemployment and make more money than I made at work.
So there's a term you can use to describe this. It's called a bubble.
Yeah.
You know what I mean? The bubble can burst eventually. Now the economy, like I said, the market's liking what's happening right now. They're liking that money's being printed and that they're basically giving all this money to the unemployed that they can spend and stimulate the economy. But
right.
If this lasts a long time, you have this massive amount of debt and the bubble can burst. That's why there is a separation between fundamentals and technicals, because if the fundamental bubble bursts, technicals can only go so far.
So the way I liken a fundamental bubble is to people or famous people, maybe a young athlete gets a big contract and he buys houses for his entire family and buys cars and doesn't get appropriate guidance and then starts to get, something we called over-levered.
Yeah, he's got all this property taxes.
He's got all these taxes and back taxes and bills. And what happens when our bill comes due? What happens to the stock market? And that's why it's important for us to talk about these things, to make sure you're not in a set it and forget it portfolio that's doing nothing other than tracking the market. You need to be sophisticated, you need to be dynamic, and you need to be strategic, okay? And again, this is why I hit on it during my radio shows throughout the week, and why I'm hitting on it again, that you cannot be in a portfolio that, number one, isn't consistently rebalanced, at least on a quarterly basis. I mean, there's case studies that even prove by rebalancing.
You add a 0.25% of value to your portfolio by just rebalancing.
Just rebalancing, because you're bringing your portfolio back into its normal harmony. What I mean by that is to say you started with a 50% bond portfolio, 50% equity, and your equities ran, and now you're a 60-40. You need to sell some of your profit to bring it back into harmony.
Right.
Because when you go 60-40, all of a sudden, now you're taking on more risk.
Right. Well,
right?
Look what would have happened if you would have rebalanced end of March, right?
Ugh.
We were recovering a little bit, right? And your bonds probably outperform your stocks, but if you brought it back to normal, like 60-40 portfolio.
March. You said the word March.
Well, I know March has had some bad months, but if you would have done that end of March in the first quarter rebalance, then you would have brought your bond allocation down, your stock allocation back to where it should be, and you would actually outperformed, because obviously
I just don't like the word March. I still like March. March used to make me think of St. Patrick's Day,
my birthday month,
and bagpipes, green beer.
I couldn't do anything this March for my
March
birthday.
will be forever lived in infamy with a 35% downturn.
Called Black March or something, Black Friday, or well, not Black Friday, Black Monday or something.
Ruin St. Patrick's Day. I don't even partake in St. Patrick's Day. I just like bagpipes.
Well, I like green beer sometimes.
Yeah. The green beer is not good for my waistline. It makes me too chubby. But again, touching on these things, the important thing to note is, again, economically, we have an issue. We have, 30 million people not working?
Yeah, now 35 million roughly.
Right. So 35 million people not working. We have the government printing money. We have car sales plummeting. Overall, we have entire industries. I even think I saw it the other day that Louis Vuitton handbags are even going up in price. Yeah. Right? Because they're like, well, no one's buying these right now, and now we're going to make them more expensive.
Because I think right now it's really what you're talking about is a separation between money between the classes, the middle class, upper class, things like that, because this is just creating a bigger wealth gap right now. Because
the only reason I know that Louis Vuitton handbag prices is going up is because my wife always wanted to justify the purchase of these handbags by saying they go up in value. And I hate to admit it right now, she was right. That never full Louis bag that she bought, she goes, if you would have let me buy it last year, it was 10% cheaper. I'm like, all right.
I wanted to buy a Rolex, and now it's like I was hoping they would like decrease in value a little bit.
Fitbit, that's where it's at for us fit athletes here.
Hey, I'm there. I'm there too, but I do want a Rolex. Yeah.
Why?
It's nice.
Is it?
It is. I mean, it's perceived to be nice. So I want to have something that
here's what I would think about one of those fancy watches. Even though I kind of wouldn't mind one myself. My problem is I'm like a big lumbery guy, and sometimes I forget I have like a watch on or whatever.
Yeah, you're good. And you fight, so you go in the.
I don't fight. The only thing I fight with is my toddler,
Oh.
And my toddler wins. So at the end of the day, watches are nice. It's something we would like to. I mean, maybe those are going to go up in price too.
Yeah.
So we're going to see strange things happening in the economy, whether it's, again, these markets reaching these resistance levels and breaking through.
Yep.
I find it unlikely that it runs. I feel like it kind of keeps hitting this level and hangs out for a while.
I find it unlikely from a fundamental side. I think
Right.
we will break above it,
Right.
but I don't think it's going to truly break out because I just think there's too many things that are wrong right now with the economy, with the world. I just don't think that there's going to be much buying above those levels because
Right.
unless there's true FOMO, fear of missing out. But I don't think that's going to happen.
I think the FOMO is what got us to where we're at today. And again, touching on these things, it's just to remind you that it's okay to seek additional opinions to figure out what's going on in your world. It's okay to question your advisor as to why haven't we made any changes, or why did you wait till my portfolio bottomed? You need to be proactive in these environments and seek out additional help. Whether you seek it from me at Strategic Wealth Partners or you seek it out from someone else, you need to be questioning your advisor to make sure your 401ks don't become 201ks. I've said it before, go to trg.swpconnect.com, check out our Portfolio X-Ray. We'll put together a detailed investment analysis for you that'll let you know where you stand fundamentally, okay? Again, trg.swpconnect.com. Thanks for listening. I had a great time today.
Yeah,
I was afraid that he would go a little too far off the deep end. But again, remember, you deserve dynamic, you deserve sophisticated, and you deserve strategic. Make sure you get it done. Get that second opinion now. Enjoy the sun if it is sunny where you're at. Take care. See ya.